Glass bursts, a sharp crack slicing through the tension. Shouts echo off the marble walls. Flashbulbs strobe like lightning. The Treasury Secretary storms out of a closed-door press briefing, tie crooked, papers clutched in one hand, face flushed with frustration. Scott Bessent isn't walking. He's charging down the hallway. Cameras catch a brief 5-word statement as he passes. "We sent the letters." 100. And just like that, the Capitol goes silent. Behind those words lies a diplomatic shockwave. 100 countries received what Bessent calls tariff letters. But his critics insist these weren't letters at all. They were ultimatums. No negotiation, no dialogue. Just a warning printed in black and white. Renegotiate trade under U.S. terms or face tariff rates not seen since the 1930s. According to Bessent's office, these tariffs could swing back to early year highs, with some climbing toward 50%. The problem? None of these countries had ever agreed to open trade talks in the first place. Vietnam, South Korea, and Mexico might depend heavily on U.S. exports, but most others, from Chile to Indonesia to Turkey, have remained silent. No public reaction, no statements, no calls to Washington. Their silence isn't confusion, it's calculation. It signals one of two things. Either they don't believe the U.S. will follow through, or they've already built stronger trade bridges elsewhere. And that silence has weight. Bloomberg's Global Trade Tracker reports that over 63 of the targeted countries now do more annual trade volume with China or India than with the U.S. That's not ideology, it's math. Global supply chains have shifted. So why would these nations accept a one-sided trade deal with Washington when they already enjoy smoother, lower-tariff trade corridors through BRICS and other regional blocs? What looks like resistance may actually be indifference, a quiet acknowledgement that the global center of gravity is moving east. But the timing of this policy is what truly rattles markets. The tariff rollout has been delayed 3 times, first July 7th, then August 1st, and now indefinitely. Bessent insists this isn't a retreat, but a signal, yet investors aren't convinced. The moment his remarks hit Bloomberg Terminal, the S&P 500 plunged 2.1% intraday. Not because of the tariffs themselves, but because of the chaos surrounding them. Just weeks earlier, Congress approved a $3.4 trillion tax expansion, one that many economists warn could fuel debt-driven inflation. Add tariff uncertainty to that, and Wall Street sees a perfect storm. There's no clear policy line anymore, only scattered warnings, delayed deadlines, and trade partners who no longer pick up the phone. Meanwhile, another front opens, and it's even more unpredictable. Under the administration's new directive, any nation seen as aligning with anti-American BRICS policy faces an automatic 10% penalty tariff. The catch? The term anti-American isn't defined. What counts as anti-American? Is it de-dollarization, joint infrastructure with China, multilateral payment systems that bypass SWIFT? Under such vague criteria, even allies could be targeted. Germany, for instance, might face penalties simply for settling energy imports with China in renminbi. Brazil could be hit twice over for participating in the BRICS Reserve Asset Program, a framework that hasn't even launched yet. Designed to allow commodity-based trade in oil, lithium, or grain using a shared non-dollar instrument, that program is still on paper. Yet Washington is already drawing red lines around it. This isn't diplomacy. It's a moving target, one painted on the backs of anyone trading outside the dollar system. And therein lies the deeper irony. The United States is now weaponizing the very global trade system it built. The WTO, the IMF, SWIFT, all were born from American leadership. For decades, Washington wrote the rules, funded the mechanisms, and enforced the norms of free trade. Now, as BRICS grows into a parallel economic bloc emphasizing local currency settlements and raw commodity trade, the same system is being used to isolate its creator. Interdependence, once America's greatest strength, has become its limitation. Look closely, and Besant's so-called trade strategy starts to look less like diplomacy and more like a containment doctrine without borders, a plan built not to engage but to corner. It's a shotgun wedding with no groom, a race against a clock that keeps ticking louder. The numbers underline just how much the world has changed. In 2000, the G7 economies made up about 70% of global GDP. Today, they account for less than 43%. Meanwhile, BRICS nations have risen from 18% to roughly 34%, and the gap is still narrowing. The IMF projects that by 2029, China alone could represent 19% of total global GDP. And that's before counting expansion. If pending members like Indonesia, Egypt, and Saudi Arabia join the bloc by 2026, BRICS could control nearly half of the world's productive capacity and over 50% of its critical mineral output: lithium, cobalt, nickel, and rare earths. In such a reality, what leverage does a tariff threat really hold? Washington still insists its domestic consumer market gives it unmatched power. But leverage, as every economist knows, cuts both ways. The United States imports more than $3.1 trillion in goods annually, according to Census Bureau data. China remains the top source for electronics, batteries, pharmaceuticals, and auto components, all essential to American manufacturing. Tariffs might hurt foreign exporters, but U.S. producers will bleed too, through higher input costs, disrupted logistics, and inevitable retaliation. In the end, this isn't just a trade dispute. It's a mirror reflecting the new economic order, one where influence isn't dictated solely by market size, but by who controls the supply chains of the future. And for now, Washington's threats may sound loud, but the silence coming from the rest of the world might be saying even more. Retaliation is no longer a distant warning. It's happening in real time. In 2024 alone, China's total BRICS trade reached 4.6 trillion yuan, roughly 650 billion US dollars, marking a 5.2% year-on-year increase, according to China's Ministry of Commerce. And that growth came despite global headwinds, a European recession, US rate hikes, and widespread demand slowdowns. So imagine what even mild trade realignment could do under the pressure of penalty tariffs. With a single executive order, the U.S. could push its own allies to reroute supply chains toward BRICS economies, a shift that, once made, won't easily reverse. In fact, it's already underway. Reuters reports that since 2023, over 37 countries have formalized renminbi settlement frameworks, allowing direct trade with China in local currencies. The Gulf Cooperation Council has begun yuan-based crude contracts, and both Brazil and Argentina now settle over 40% of their trade with China outside the US dollar. This isn't a theory anymore, it's execution in motion. The ripple effect is clear. As global trade bypasses the dollar, demand for U.S. treasuries weakens. Bloomberg data shows foreign purchases of U.S. government bonds have dropped by $289 billion in the past year, the sharpest decline since 2016. The biggest sellers? BRICS nations and their primary trading partners. China's holdings alone fell by $12 billion, its fastest drawdown in nearly a decade. The logic is straightforward. Less trade in dollars means fewer dollars to recycle into U.S. bonds. That collapse in Treasury demand pushes U.S. borrowing costs higher, triggering what analysts now call Besant's boomerang effect. But China isn't just selling treasuries, it's buying gold. The People's Bank of China added 70,000 troy ounces in June, bringing its 8-month total to 34.2 metric tons per official disclosures. This isn't about chasing yield, it's about building trust. Gold doesn't carry political risk, sanctions exposure, or U.S. debt drama. And that's precisely why it's becoming BRICS' preferred safety net. The irony is thick. A metal once demonetized by Washington is now the very asset being weaponized by Beijing. Even Europe is making quiet but telling moves. In a rare pivot, a German church pension fund recently invested $50 million in a Hong Kong-based Chinese equity fund, according to the Financial Times. The move was justified as a search for high-growth, undervalued industrial and tech exposure. But symbolically, it's enormous. A NATO-aligned entity channeling capital into markets that Washington increasingly labels adversarial. While Besant debates tariff triggers, BRICS is quietly absorbing Western investment. The markets have noticed. Year-to-date, the Hang Seng Index has surged 21.3%, while the S&P 500 trails at 6.7%. No, Wall Street isn't collapsing, but capital is diversifying. Traders are beginning to price in chronic instability in U.S. fiscal and trade policy. And when volatility becomes structural, yield alone can't hold capital. Investors start chasing systems, not spikes, sustainable ecosystems that feel stable, which makes China's next move all the more provocative. According to Bloomberg, Beijing is considering expanding its southbound Bond Connect program, a policy that would allow up to 1 trillion yuan, or about $140 billion in outbound capital flows. This means China's institutional investors could soon buy foreign debt, from Eurobonds to U.S. corporate paper, with far fewer restrictions. On the surface, it might seem dollar-friendly, but in practice, it's a step toward Wall Street displacement. The People's Bank of China reportedly aims to create what it calls reciprocal flow, a mature financial ecosystem centered in Hong Kong, designed to attract inbound global capital while opening outbound access for Chinese institutions. The endgame? A self-sustaining financial hub that functions without Wall Street, and eventually, against it. With the Hong Kong Stock Exchange preparing to list multiple sovereign BRICS bonds, that vision is moving closer to reality. Meanwhile, U.S. fiscal strategy is feeding the fire. The latest tax bill added $3.4 trillion to the deficit, according to the Congressional Budget Office, while inflation projections for 2026 have jumped 1.7 percentage points. The deeper problem, though, isn't just economic, it's political. The Joint Committee on Taxation reports that the top 20% of earners will see a 2.3% income gain, while the bottom 20% will lose 2.3% in real purchasing power. Combine that with tariff-driven price hikes, and the economic strain becomes severe. When the middle class can't spend, growth stalls. Retail contracts. Small business investment freezes. It's a replay of the 1970s stagflation playbook, only this time with new actors and global competition. The Peterson Institute for International Economics warns that if August tariffs take effect, inflation could surge between 15 and 20%, putting unbearable pressure on American households. Contrast that with BRICS economies, which are easing credit, lowering rates, and subsidizing trade. The contradiction is sharp. The U.S. tightens, while BRICS accommodates. And perhaps the most sobering realization is that this entire global shift was engineered using America's own blueprint. Trade corridors, digital payment rails, reserve frameworks, and supply chain models first developed by U.S.-backed globalization. This isn't a coup, it's a remix. The tools once built to expand American influence are now being used to balance, even challenge it. And if Washington continues to threaten instead of compete, it won't be tariffs that isolate the U.S. It'll be gravity. So, the question stands. Will BRICS back down? Will Washington recalibrate? Or are we watching the final fracture of the old trade world? Let us know what you think in the comments. And if you're enjoying this breakdown, don't forget to like and subscribe for more global analysis just like this.